Some of the tried and true tech companies have helped portfolio manager Nick Clay provide strong returns for the Dreyfus Global Equity Income Fund with more than $400 billion in assets under management. Nick joins me now, and it's nice to see you in New York.
Thank you very much for having me.
And it's interesting, you're based in London, so you do have a global perspective. I want to get your impression between now and the end of the year in the U.S. We got our Federal Reserve meeting out of the way, right? The big one that people were worried about. Now we have a U.S. election. Is this a distraction, or is it an issue that will create volatility in U.S. markets, do you think?
I think it will certainly create volatility in US markets. I don't think it's just a distraction because of the Trump factor this time round. The ability of someone to come into power who's so unknown, so uncertain. Markets do not like uncertainty. It will certainly cause volatility. And equally his views on who should lead the central bank. You know, if he gets into power, he's been fairly vocal that Yellen probably isn't his woman, and therefore there will be change at that level as well. All of that will lead to uncertainty. So the market certainly could experience volatility going into this.
And you, of course, manage for the long term. You look at stocks that act a little bit like bonds in terms of dividends and the like. I mentioned technology companies, which we'll get to in a moment, but you also like healthcare and utilities. Healthcare in particular is one of these sectors that everyone's been beating up on ahead of the election. So what do you see in there that's attractive?
Well, we think that healthcare is very much an industry where you're seeing innovation again, particularly in the development of drugs, which is something new for the industry. For quite a long time it wasn't being innovative in drugs, and therefore rightfully so there was pressure on pricing of those chemical drugs. Now the biological drugs can be innovated, they should be able to protect franchises. It can change dramatically the cost structure of how you bring a drug to market, and the ultimate cost of the end payer, the government too. Everyone can benefit from that. And so we try to focus on those companies which have that innovation and therefore better able to be able to grow their businesses over the next foreseeable future, 5 to 10 years. And because they've been beaten up, the valuation still looks attractive in those areas.
And those would be the major healthcare companies in the US?
Yeah, some of the big ones, yeah. And in Europe as well.
And in terms of the technology stocks, they've done well by you, quite frankly, in terms of some, I would say they're almost like tech companies that nobody really thinks as much about when we look at your top holdings. Names like Microsoft, Cisco are in there. What are investors missing out with some of those stocks? Because others have, of course, moved to 52-week highs, many of them.
Mainly due to the fact that they're mature tech. So as you rightfully intimate, that people have kind of discarded them as slightly boring, somewhat old. But what we are drawn to is the stability in their returns on invested capital, the cash flow that they generate on a durable fashion, and the fact that from a valuation perspective, you're not asked to pay a great deal for that. Still good high single-digit free cash flow yields are available on these stocks. And therefore, from an investor's point of view, you're not having to pin a lot of hope on the next new product being the next greatest thing, or the continued exponential growth rate that comes out of that company. You can pretty much bank on that cash flow coming through, and that ultimately will drive your returns. We find that very appealing, and particularly if you get it back as a dividend.
Anything you find really unappealing right now in terms of sectors?
Plenty. Banks. We hold no banks. We hold no mining companies. We hold nothing in emerging markets. We think there's quite a lot of risk around at the moment, quite a lot of fragility, despite what some of the volatility indices would indicate, which is that there's no volatility to be worried about. We think the opposite is true. And valuations as a whole are fairly stretched at the moment around markets, and so therefore you have to be very careful what you're investing in. The number of holdings in our strategy is at the lowest it's been for 10.5 years. We are the most concentrated and committed today because of where valuations are as a whole.
And just quickly, what is the biggest risk coming from, do you think?
From QE, from the distortion of markets, the distortion of asset prices. Pumping up asset prices at the expense of not improving fundamentals just creates ultimate fragility and therefore risk down the line.
All right, things to watch for. Nick Clay, it's been great speaking with you. Thanks for coming in.
Thank you very much for having me.
I'm Rhonda Schaffler for The Street.